Welcome to Magic Minutes by MGIC, mortgage industry training that helps you expand your knowledge and skills. Before we get started, take a moment to review our legal disclaimer. MGIC is providing this as general information based on current industry guidelines at the time of this recording. It is always advised that you seek the guidance of your own compliance and regulatory departments.
Welcome to our series on analyzing self-employed income. I'm Sandra Sweeney, Senior Customer Trainer and Program Designer for MGIC. In this short tutorial, we'll discover how when it comes to cash flowing Schedule C, there might be additional add-backs in the form of vehicle mileage depreciation. We'll start by uncovering two types of depreciation. We'll then outline the differences between actual expenses versus standard deduction. And lastly, we'll go over 3 steps that we take to determine whether there is additional depreciation that can be added back. So, let's get started. Depreciation is the reduction in value of an asset over time due to wear and tear. Examples of items that may be depreciated are office furniture, equipment and work vehicles, and office buildings. Looking at our MGIC SAM cash flow analysis worksheet in the Schedule C section for the sole proprietorship, you will note that depreciation can be found on line 13 of the borrower Schedule C. However, it shows up again on the worksheet as mileage depreciation. Depreciation is a non-cash expense or paper loss, which did not require the business to have any outlay of money. Therefore, when we encounter depreciation on line 13, we know this can be added back during cash flowing, but it appears that there's additional depreciation that can be considered. Why is this? This is because there are 2 types of depreciation: depreciation of business equipment, machinery, or buildings, and then there is vehicle mileage depreciation. Can vehicle mileage depreciation be added back? The answer is going to be, it depends. Did our borrower claim actual expenses or use standard mileage rate? When the business owner first places a vehicle into use for business purposes, they make this choice. Are they going to use actual expenses, where they keep the receipts throughout the year and claim actual costs? Or are they going to keep track of the number of business miles and use the standard mileage rate? Why is this important to us? Well, let's say that they opted to use actual expenses. Then vehicle depreciation would be included in line 13. Therefore, we would not be able to add back anything further. What about an individual who opts to use standard deduction? In this case, vehicle depreciation is reflected on line number 9. We would then take the business miles and multiply by the depreciation rate for that particular tax year to come up with the vehicle mileage depreciation, which can then be added back. So, if standard deduction is confirmed, then vehicle mileage depreciation can be calculated and added back during cash flowing. Each year, the IRS issues a standard deduction rate and also provides the rate for what portion can be attributed to depreciation. Then business miles would be multiplied by the depreciation rate to determine the vehicle mileage depreciation. For example, looking at Schedule C, page 2, line 44A, we see that there are 12,000 business miles. For tax year 2021, the depreciation rate is 0.26. Business miles of 12,000 can be multiplied by 0.26 to determine vehicle mileage depreciation of 3,120. To streamline this process, our MGIC SAM worksheet has the rates for each year built into the worksheet. But where do we find business miles? We already know that vehicle business miles can be found on page 2 of Schedule C on line 44A. But did you know that if your borrower has more than one business vehicle or is filing special depreciation, then mileage will be reported on IRS Form 4562, Section B, line 30, and many times can be found on a supporting statement. And you should be aware that this process involves more than just plugging mileage into a worksheet. There are 3 steps for vehicle mileage depreciation analysis. Step number 1, check all tax documentation for business miles. Step number 2, confirm standard deduction was used. Step number 3, include all vehicle depreciation in cash flow. Now that we know the steps, what does this look like in real life? And how do we check for standard deduction? Let's look at some tax returns and go through these 3 steps. Step number 1, looking at a 2021 Schedule C and checking for business mileage, we see 12,000 business miles. Moving on to step number 2, confirming standard deduction. Bringing up our yearly table, we see that for the year 2021, the standard deduction rate was 56 cents per mile. Multiplying the mileage of 12,000 by 0.56 gives us a total of 6,720. To check to see if the borrower utilized standard deduction, we would look to see if this is the figure sitting on page 1, Schedule C on line number 9. In our case, line number 9 does reflect 6,720, and therefore we have confirmed that standard deduction was used. So in step number 3, we know that we are able to input the miles of 12,000 into the worksheet, and the worksheet is going to apply the applicable rate for 2021 and add in 3,120, which is the amount attributed to depreciation. Please use caution and watch your step, because you should be aware that mileage reported does not always equal mileage claimed. Let's say that in step 1, we see the same 12,000 miles on Schedule C, line 44A. This time, when we attempt to confirm standard deduction and we multiply the mileage of 12,000 by 0.56, which equals 6,720, and we check on line number 9, we see a figure of 1,000, which of course does not equal 6,720. And therefore, we know that standard deduction was not used. So in step number 3, no vehicle depreciation can be added back due to the fact that since actual expenses were used, depreciation is already included in line 13. What about tax year 2022? In 2022, the standard deduction changed mid-year. For the first half of the year, the standard deduction factor was 58.5 cents per mile, and in the second half of the year, it was increased to 62.5. Confirming standard deduction is a bit more complicated for tax year 2022 due to the mid-year change. One way to handle this would be to request the breakdown from the accountant. Or you could calculate an estimated figure as follows. In our example, we split the 12,000 miles and used 6,000 for each portion of the year, multiplying half at a rate of 0.585 and the other half at a rate of 0.625, which added up to 7,260. And indeed, this is what was reflected on line number 9. However, this will not be an exact calculation for tax year 2022. Now you can see that determining vehicle mileage depreciation is a bit more complex than you may have thought. Knowing where to look for business miles on tax forms and being able to confirm that your borrower used standard deduction versus actual expenses are crucial steps in the correct calculation of your self-employed borrower's income. Taking the time to thoroughly understand these concepts is imperative towards allowing you to avoid mistakes and be the best advocate possible for your borrower.
Thank you for joining us for Magic Minutes. We hope this brief tutorial has made a difference for you. For more how-to videos, visit mgic.com/training.